Good morning, and this morning we're talking about the Bank of England base rate. What's driving inflation, how mortgages are affected, and why you should put the 18th of September 2025 in your diary. Now, at the beginning of August, the Bank of England dropped the base rate from 4.25% to 4%, marking the fifth rate cut of this year. But this was after a very narrow 5-4 Monetary Policy Committee vote. The underlying reasons were that the bank faces a balancing act, trying to cool inflation while supporting slowing economic growth. So let's look at inflation first. The Consumer Price Index, or CPI, hit 3.6% in June 2025, with the bank currently expecting it to peak at around 4% this month. And we're likely to only see a return to the target 2% sometime in 2027. Now, adding to the mix are pressures in food and energy prices, public sector wage demands, particularly with the unpredictability of US tariffs complicating the international outlook. So how does all this affect your mortgage? First, let's talk about trackers. Tracker mortgages are closely tied to the Bank of England base rate. So these will pretty much move in step. And then there's standard variable rate mortgages. Nationwide, for instance, cut its variable rate from 6.99% to 6.74% from 1st of September. And then, of course, there's fixed rate mortgages. Now, if you're currently in a fixed rate mortgage, then you're tied to your rate until the end of your fixed term, unless, of course, you want to pay the early repayment charge. And then, of course, when your fixed term ends, you either need to get yourself a new deal, or you'll be moved on to a standard variable rate. So let's look ahead at what's next, because market expectations are shifting. So what's the outlook for 2025? Well, some forecasters are saying that there could be one or even two more rate cuts this year, taking the base rate down to around 3.75%, potentially in September and November. But not all forecasters agree, and other forecasters like Deutsche Bank are becoming a lot more cautious, saying we won't see any more rate cuts until probably 2026, mainly due to persistent inflation. So the path ahead for this year and next year very much depends on economic growth, inflation trends, and labour market data. So to try and sum all this up, in September, the Monetary Policy Committee brought the rate down to 4% from 4.25%. Inflation is currently at 3.8% and potentially rising to 4%. So that's well above the 2% target. If rates do come down further, then that's going to benefit anybody with a tracker. But generally, fixed rates are probably stable for now. And yes, we can expect further cuts, but maybe not until 2026. So don't panic, but stick a ring around the 18th of September in your diary. And be sure to check back with us for an update after the announcement. I'm Patrick, thanks for watching, see you next time.